Somewhere in the bustling heart of Tokyo, a seemingly mundane event occurs in the bond market, and halfway across the world, Wall Street trembles. This isn't speculation or dramatic storytelling. This is the interconnected reality of modern finance, where a single shift in one corner of the globe can unleash chaos everywhere else. Right now, while politicians debate, while social media buzzes with trending controversies, and while most investors obsess over the latest earnings reports, something far more dangerous is unfolding in plain sight. Before moving next, if you have not subscribed our channel, please subscribe to my YouTube channel for latest update. The free money era that has propped up markets for over 2 decades is collapsing, and the warning signs are screaming from a place most people aren't even looking. For 25 years, Japan has served as the world's financial foundation, the invisible engine pumping cheap capital into every corner of global markets. Their interest rates sat at zero, sometimes dipping below, creating an unprecedented opportunity for the entire investment world. Hedge funds, banks, and institutional investors borrowed Japanese yen at virtually no cost, converted that currency into dollars, and deployed it into American stocks, real estate, cryptocurrencies, and bonds. This mechanism, known as the carry trade, became the secret sauce behind the enormous bull markets we've witnessed. Trillions of dollars flowed through this channel, inflating asset prices to levels that seemed disconnected from underlying economic fundamentals. The game was simple and extraordinarily profitable, until now. The Japanese government's 30-year bond yield recently surged past 3.5%, while the 10-year yield crossed above 2%. These might sound like arbitrary numbers to the casual observer, but to anyone who understands the plumbing of international finance, these figures represent a seismic shift. We haven't seen yields at these levels since the late 90s, back when the internet was still dial-up and the dot-com bubble was just beginning to inflate. What makes this development so critical isn't just the numbers themselves, but what they signal about the future. The cost of borrowing yen has suddenly become expensive. The free money spigot that Wall Street has relied upon for decades has been abruptly shut off, and the consequences are beginning to ripple through every market on Earth. Understanding why this matters requires grasping how the carry trade actually functioned. Imagine you're managing billions of dollars and you're constantly seeking ways to maximize returns. You discover that Japan offers loans at essentially zero interest, so you borrow 1 billion yen, paying almost nothing for the privilege. You then exchange those yen for dollars and use that capital to purchase assets yielding 5 or 10% returns. The difference between what you pay and what you earn becomes pure profit. This strategy worked flawlessly as long as 2 conditions remained stable. Japanese interest rates stayed near zero, and the yen remained weak against the dollar. For years, both conditions held firm, and the carry trade became the largest source of leverage in global markets. Fund managers borrowed with reckless abandon because the trade seemed risk-free. But financial markets have a way of punishing complacency, and that punishment is arriving with brutal efficiency. When Japanese rates climb, the entire calculation changes overnight. That cheap loan suddenly carries real costs. The interest payments that were once negligible now eat into profits. Even worse, if the yen strengthens against the dollar, which it inevitably does when Japanese rates rise, borrowers find themselves owing back more than they initially borrowed. This creates a devastating feedback loop. To repay these increasingly expensive loans, investors must sell the assets they purchased with borrowed money. They dump American stocks, unload treasury bonds, and liquidate positions across all asset classes. This selling has nothing to do with corporate earnings, economic growth, or any fundamental factor. It's purely mechanical, a forced deleveraging driven by the mathematics of currency and interest rates. The pressure builds with every basis point that Japanese yields climb, and we're watching this process accelerate in real time. The 3.5% threshold on the 30-year bond carries special significance because of Japan's unique demographic and financial structure. Japan is a nation of savers with massive pension funds and insurance companies managing trillions in assets. For 2 decades, these institutions couldn't generate meaningful returns at home because domestic rates were stuck at zero. They had no choice but to invest overseas, becoming the largest foreign holders of American government debt and accumulating over $1 trillion in United States treasuries. But now, for the first time in a generation, they can earn attractive returns at home without taking on currency risk or geopolitical uncertainty. Japanese fund managers have been explicit for years that if domestic yields reached 3%, they would begin repatriating capital. We've now blown past that number, triggering what experts are calling the Great Repatriation. This capital flight creates an enormous vacuum in American markets. If Japanese investors stop purchasing United States debt and actually begin selling their existing holdings, who steps in to fill that void? The answer is deeply troubling. China has already been reducing its treasury holdings for years. Private investors are maxed out. American banks are stuffed with government bonds and facing their own balance sheet constraints. The only entity with the capacity to absorb $1 trillion in selling pressure is the Federal Reserve itself. This forces the central bank into an impossible corner. If they allow Japanese selling to push treasury yields higher, interest rates across the American economy spike, breaking the housing market, crushing consumer spending, and potentially triggering a cascade of bank failures. The alternative is for the Fed to become the buyer of last resort, printing fresh dollars to purchase the bonds that Japan no longer wants. This is textbook debt monetization, the classic endgame of over-leveraged economies, and we're watching it unfold with mathematical certainty. We've already witnessed a preview of this crisis. Last summer, when the Bank of Japan nudged rates higher by just 0.25%, global markets convulsed. Japanese stocks plummeted 12% in a single session, the worst daily drop since the crash of 1987. Cryptocurrency markets imploded. American technology stocks collapsed. The entire episode lasted only days before central banks intervened with soothing language and coordinated support. But it provided a terrifying glimpse of the system's fragility. That was a warning shot with rates barely moving. Now, with yields at multi-decade highs and climbing, the pressure has multiplied exponentially. If a tiny rate adjustment caused that much chaos, what happens when the adjustment is 10 times larger? This brings us to the concept that will dominate financial discussions throughout this year: yield curve control. Japan pioneered this policy, essentially promising to cap government bond yields at specific levels by printing unlimited amounts of currency to buy bonds whenever yields threaten to rise above the target. It's the ultimate act of surrender by a central bank, an admission that they're prioritizing government solvency over currency stability. Once yield curve control is implemented, the bond market becomes a zombie, offering capped returns while inflation runs wild. Capital flees these rigged markets, searching desperately for assets that can't be manipulated or debased. This is where precious metals enter the picture with explosive force. Silver occupies a unique position in this unfolding crisis. Unlike purely financial assets that exist as entries in computer systems, silver is a physical commodity that can't be conjured out of thin air by central banks. It serves dual roles as both an industrial metal critical to modern manufacturing and as monetary insurance with thousands of years of history. When government bonds lose their status as risk-free assets, which happens when central banks cap yields while printing money, investors scramble to find alternatives. Gold captures the monetary hedge trade, but silver offers something additional. It has industrial utility, particularly in the electronics, solar energy, and automotive sectors that drive modern economies. As Asian manufacturing powerhouses see their currencies strengthen through repatriation, their purchasing power for raw materials increases, allowing them to secure strategic stockpiles of critical resources. The convergence of monetary fear and industrial demand creates a perfect storm for silver prices. History provides a clear roadmap of what happens during these liquidity crises. In 2008, when the financial system collapsed, silver initially crashed from $20 to $9 as panic selling overwhelmed everything. But then the Federal Reserve announced quantitative easing, printing trillions to stabilize banks and bond markets. Silver subsequently exploded from $9 to nearly $50 over the following 3 years, a 500% rally. The pattern repeated in 2020 when pandemic lockdowns triggered another crisis. Silver fell to $12 before Fed intervention, sent it soaring to $30 within months. The playbook is always the same. Crisis causes crash, crash forces printing, printing causes rally. We're currently in the volatile transition phase where things are breaking, but the printing response is inevitable because the alternative, allowing the treasury market to fail, is politically and economically unthinkable. What makes this cycle different is the starting point. Previous crises saw silver trading in single digits or low double digits before the monetary response ignited rallies. Today, we're starting from the 70s, a dramatically higher base that reflects years of supply deficits and growing awareness of silver's strategic importance. If we simply apply the doubling that occurred in past crises, silver reaches $150. But this crisis may prove more severe because it's attacking the foundation of the entire dollar-based system. When Japanese yields hit 3.5%, they're not just causing a localized problem. They're triggering a global margin call that forces deleveraging across all markets simultaneously. The scale of borrowed money supporting current asset prices is astronomical, and it all has to be repaid in a compressed time frame. The banking sector adds another layer of vulnerability to this crisis. Global banks have constructed a massive derivatives market built on the assumption that interest rates would remain permanently low. The notional value of these contracts runs into the hundreds of trillions, with the actual money at risk estimated around $20 trillion. Most of these derivatives are interest rate swaps where banks receive fixed payments while paying floating rates. They're betting that rates stay stable using enormous leverage to profit from tiny spreads. When Japanese rates surge, they push floating rates higher globally, moving the odds against these bets. Even small moves can generate catastrophic losses when leverage is extreme. We're already seeing signs of distress, with Japanese banks reporting significant losses from foreign bond portfolios and American banks sitting on hundreds of billions in unrealized losses. The danger isn't just that one institution fails, but that counterparty connections spread the contagion throughout the system. Hedge funds that executed the carry trade pose another systemic risk. They borrowed yen from prime brokers, the divisions of major banks that service hedge funds, and used that leverage to chase returns. If these funds blow up because the yen spiked and their trades went underwater, the losses don't vanish. They travel up the chain to the prime brokers who made the loans. A few years ago, a single fund called Archegos Capital imploded and cost one bank $5 billion. Now imagine that scenario playing out across dozens of funds simultaneously. Banks would suddenly realize their clients can't repay, forcing them to hoard capital and stop lending. When credit freezes, economies grind to a halt, pressuring central banks to intervene, not to save the economy broadly, but specifically to rescue banks from their own client failures. This creates the Federal Reserve's nightmare scenario. Their official mandate includes price stability and maximum employment, but they also have an unwritten third mandate, financial stability. Right now, inflation remains elevated by historical standards, suggesting they should keep rates high to cool the economy. But financial stability is flashing warning signals as the Japan shock stresses banks and markets. History consistently shows that when these objectives conflict, central banks choose stability over inflation control. They'll likely be forced to pivot, cutting rates or restarting bond purchases even while inflation runs above target. This policy error, abandoning the inflation fight to prevent financial collapse, becomes rocket fuel for hard assets. Investors recognize that their cash is being deliberately sacrificed to bail out Wall Street, prompting a flight from currency into tangible stores of value. The case for physical ownership becomes paramount during banking crises because of counterparty risk. If your silver exposure comes through an exchange-traded fund, a pool account, or futures contract, you're dependent on a financial intermediary, usually a bank, to honor their obligations. If that bank faces solvency issues because their yen carry trades imploded, your silver claim could become part of their bankruptcy proceedings, leaving you as an unsecured creditor fighting for pennies on the dollar. Physical silver held in your possession has no counterparty. It doesn't care whether banks are solvent or what Japanese bond yields are doing. It's an asset that stands alone, immune to the cascading failures that can wipe out paper claims overnight. During periods of financial stress, premiums on physical coins and bars rise sharply as people wake up to the danger of leaving wealth trapped inside stressed systems. We're seeing this dynamic begin to play out now as savvy investors check the exits while they're still accessible. Looking at potential price targets requires examining historical ratios and monetary dynamics. Gold is currently trading around $4,500 per ounce. During monetary crises, the gold to silver ratio typically compresses from elevated levels back toward historical norms. The modern average sits around 40 to 1, meaning 40 ounces of silver equal 1 ounce of gold. If we apply that ratio to current gold prices, silver reaches $112. That's the conservative case, assuming gold stays flat. If banking stress intensifies and we see institutional failures, the ratio could compress to 30 to 1, pointing silver toward $150. In a true panic scenario, reminiscent of the 1980 mania, the ratio might briefly touch 15 to 1, implying silver at $300. These aren't wild speculations, but mathematical outcomes based on repeating patterns in monetary history. The path from current levels to these targets won't follow a smooth trajectory. As the carry trade unwinds and margin calls force liquidations, we'll see violent volatility with silver potentially dropping $5 or $10 in a single session. These shakeouts are deliberate, designed to terrify holders into selling physical positions so banks can cover their paper short positions at favorable prices. Understanding the macro backdrop becomes crucial for maintaining conviction during these inevitable drawdowns. When you see a brutal red day, remember why it's happening. The global ATM is closed, cheap money is gone, and the liquidity tide is reversing. For the fiat system built on endless leverage, this reversal is catastrophic. For physical assets that can't be printed or leveraged, it's ultimately bullish because capital must go somewhere when digital claims lose credibility. The convergence of multiple crisis vectors makes this moment unique in financial history. We have the microeconomic factors with supply deficits in silver driven by industrial demand from electronics, solar panels, and electric vehicles. We have geopolitical tensions fragmenting global trade and supply chains, making strategic resource hoarding rational policy for nation-states. And now we have the macroeconomic catalyst, with Japan's rate moves forcing a global deleveraging that must end in either deflationary collapse or inflationary money printing. Central banks will always choose inflation over collapse, which means the printing presses will run regardless of the rhetoric about fighting inflation. When that reality becomes undeniable to mainstream investors, the repricing of hard assets will be breathtaking in its speed and magnitude. What we're witnessing unfolds in slow motion for those paying attention, but will feel sudden and unexpected to the majority. The butterfly in Tokyo has indeed flapped its wings, and the hurricane building over financial markets is just beginning to gather force. The free money era that defined investing for an entire generation is ending, not with a policy announcement, but with mathematical inevitability. Interest rates must either stay low and destroy currencies through inflation, or rise high and destroy borrowers through default. There's no middle path that preserves the status quo. The carry trade, unwind, Japanese repatriation, and forced Federal Reserve intervention form links in a chain of causation that leads inexorably to currency debasement and hard asset appreciation. Understanding this sequence gives patient investors an enormous advantage. While others panic at volatility or remain oblivious to the macro forces at work, those positioned in physical silver can weather the turbulence and emerge on the other side with wealth preservation and dramatic purchasing power gains. The repricing event has begun, the mechanisms are in motion, and the outcome is foreseeable for anyone willing to follow the trail of cause and effect through the interconnected maze of global finance.